Hey everyone, it's Paul with the Tuesday Bull Profits. So before I start off this video, I usually give 3 disclaimers, disclosures, warnings, if you will. The first is that none of the videos, material on here are financial advice. This channel exists largely for informational engagement, even entertainment purposes, to the extent you consider finance, money to be entertainment. And this is not financial advice. So the primary reason really that we're on here is obviously to provide something to you. However, we also have a publishing company that backs us. It's called Bull Profits. We have 8 investment newsletters. And so this is a way to get our ideas out, get our names out, get you interested in subscribing in our investment newsletters. And our flagship one is called Profits Unlimited. And if you're interested in checking that out after watching this, or if you've been watching this channel in the past, go to profitsunlimited.com and it will give you a web page that will show you how you can subscribe. There'll be a link below as well to it. Second thing I want to mention is that any of the ideas that we're talking about in our videos, they're intended to be for the long term, minimum 1 to 3 years. And I really stress the minimum part, minimum meaning like really minimum. We're not kidding, actual minimum 1 to 3 years. We have stocks in our portfolios, for example, in Profits Unlimited, that we've been in for nearly 5 years. So we will stick with our ideas as long as we have belief in it, conviction in it, and believe that they are going to pan out because the upside we believe is so huge. So we are long-term, if you will, certainly relative to day trading, week trading, month trading, or the very short-term timeframes that a lot of people are looking for. So if you're looking for that, we're the wrong channel for you. There are hundreds of channels out there that really cater to you, and I would encourage you to go seek one of those out. The third thing I want to mention is that there's also an extraordinary amount of fraud and scam activity around my name, my picture, my incredible colleagues, Ian Dyer and Amber Lancaster. You may find things on Facebook, Twitter, Snapchat, on the internet generally, asking you to send money, asking you to send Bitcoin or cryptocurrency. And this is all a fraud. They're just really banking on the fact that we do have a large number of subscribers for our paid services, in excess of 100,000 people. And so they are trying to use our names and our credibility to really get money out of you. And please never send money to them, never send crypto or Bitcoin to them. They're a fraud, they're a scam. Anything that we have to offer you is going to be in the form of a subscription that you will need a credit card to subscribe. So before I get on, last thing, if you have been a long-term watcher of this channel, please subscribe to the channel, give us a thumbs up. And once you watch the video, comment below on what you thought of it. So today I want to do a little bit of an educational video. And I want to talk about something that is always top of mind for many investors, because this is fundamental to all investing, all speculating, all trading even, which is dealing with volatility. And quite recently, as a result of many of our stocks, and we focus on stocks that tend to be pretty volatile. We call them America 2.0 stocks, Fourth Industrial Revolution stocks. The outside world would refer to them as growth stocks. We're sort of like laser focused on that, on these newer companies that represent technological megatrends that are significant, that we believe are changing the world right now. And they can be volatile because people can want to take profits. People can maybe suddenly lose interest in it. And from my experience, and I've been on Wall Street managing hedge funds, mutual funds for about 2 decades before I came to this role. And based on my experience, knowledge, and understanding, here are the things as to why stocks are so volatile. And you could, by extrapolation, sort of also extend some of these, not all, to crypto markets and other markets as well. So why are stocks so volatile? Well, from my experience, the number one reason is because a significant amount of the people who participate in Wall Street have incentives that make them focus on short-term profits. And so the number one here that I have on my list is hedge funds. Hedge funds have generally a 1 year time frame. They're measured based on their performance on December 31st of each year. So all of their actions, all of their trades, all of their thoughts are generally made up with the perspective of they need it to hit by that time frame, and they get paid 20% of the profits. So many hedge funds have a fee structure where they get 2% of the assets and they get paid 20% of the profits. So your goal is trying to optimize for a certain date. And oftentimes it's a lot shorter than that, because if you have a big winner, let's say you had a stock that's gone up 15 or 20% or 50% or a few 100%, you're just going to take that profit and even sit in cash for a few months or a few weeks because you never want to risk it. So there are a lot of people like hedge funds out there that have very short-term sort of incentives, which then drive very short-term timeframes. Mutual funds, which represent trillions of dollars on Wall Street, also have short time frames. They're driven in many cases by bonuses. When I was a portfolio manager on Wall Street, we got bonuses at the end of every year, partly based on what the performance of our fund was. So of course you want to put stocks into your portfolio that can go up sooner. And then that drives a certain chasing mentality that drives sort of short-term decision-making and short-term trading. Something that's true for both hedge funds and mutual funds, hirings and firings. If you have very poor annual performance, while a lot of mutual fund companies or even hedge fund companies will say, well, we're in it for the long term, they will fire you if you have one bad year. Truthfully, there are hedge funds and mutual funds that may fire you for one bad quarter, let alone 1 year. So a lot of times in this business of managing money, the critical thing that the person managing money is, they're looking out for their own both short-term and long-term financial stability themselves, rather than opening their mindset out and taking long-term bets that can be very, very rewarding. However, it does require perhaps having a quarter or two, or maybe a year even, where your performance may be bad. So that's item number one. The reason why stocks are volatile is that there are a lot of people who are incented to really trade on very short-term incentives. All right. So the second thing is a good number of people that are involved in speculating, trading, investing are very short-term speculators, because the markets, they can be treated like event betting. And in other words, it's kind of like going to the racetrack and betting on races. And what do I mean by that? Well, if you think about it, every single company that you can buy has at least 4 events that you can think of. And if you just think very quickly, of course, they report their earnings every quarter. So 4 bettable events. And that's the way any number of hedge funds and truthfully, any number of investors will bet. They will bet on earnings surprises or earnings disappointments, go long or go short. Another one that is pretty obvious is options expiration. There are any number of companies that actually have weekly options that expire. So every Friday, these expire. The bigger ones are every quarter, and they are different than the earnings date. So that's 4 more events. Then there's futures. They have their own expirations. There's options on futures. So you can see that there's a lot of events that you can bet on, and a lot of short-term speculators really bet on these things, and this is the way they make their money. They really never even sometimes know what a company does or anything like that. They're just focused on the event. They're focused on the demand and supply balance around that event and trying to make bets. Another one that I've actually had personal experience in is with respect to certain industries. For example, biotechnology and pharmaceuticals, they have a lot of events, clinical trials. They have to put out their results, and people will bet that. FDA approval is another one. People will bet that. So that's reason number 2 why stock markets are so volatile, which is that you have a good number of people who are very short-term speculators that treat the markets like an event betting, like a racetrack, and where they're betting on horse races. All right. Reason number 3, and this one I think is kind of hard for many people to understand. There are many very large players. We're talking about people with trillions of dollars of exposure to the stock market that sometimes have to buy and sell in very large quantities. They use strategies like asset allocation. So, for example, there is a sovereign wealth fund for Norway, and they've got trillions of dollars. If they decide that they would like to sell as a asset class US stocks or US small cap stocks or US mid cap stocks, they're going to be selling billions of dollars, potentially tens of billions of dollars, maybe even in some cases $100 billion or so. And when they go to sell, prices are going to get marked down. In other words, there is no natural buyer, if you will, on a 1 minute basis, 1 second basis when they decide to sell for that much stock. So the way that gets dealt with on Wall Street is that that's done by negotiation. And the price when you sell on a wholesale basis is always lower than retail. That's one way to think about it. And the thing is that when you see this kind of a transaction that's actually gone on in the background, the prices get marked down for all of us because that price is transmitted to everybody. And now you experience that as a price going down, being in decline. And then, of course, it can trigger by itself a whole series of additional transactions that many people use to sort of constrain their own volatility. Trailing stop losses is a big thing. I know there are services that claim that they can tell you exactly when to get out based on a volatility quotient and all of these kinds of things. And all of these things now drive additional selling that cause additional volatility. So there's an entire sort of industry and mechanical element to selling that is driven by the fact that large owners of stocks sometimes need to sell in very large quantities. And when they do, they cause the price of things to go down for non-fundamental reasons. In other words, there's nothing wrong with the company. The sovereign wealth fund of Norway can simply decide that they want to lower their exposure to the US stock market. And that can cause many people now to really think that there's something wrong and sell. And as I mentioned, trailing stop losses, particularly by regular investors, retail investors, mom and pop investors, is a big thing. And in truth, I personally disbelieve in that. And I believe that people end up hurting themselves by following things like that. There is also the reverse side of that, which is that when a big investor wants to come in a fairly big way, you can also see prices rise very quickly. That, of course, we like. So we don't really consider that to be volatility. We consider that to be gains. So I won't really get into that. Bottom line to this is that when big investors are selling, they can move prices down that are unrelated to anything to do with the company. However, you can see a big impact from it. The fourth is related in a way to what I just said, which is that when a big investor sells and causes prices to be marked down, as I put it, and then all the machinery of Wall Street, kicks in between trailing stop losses and hedging and whatever else, the financial media now uses that volatility and constructs sensational sort of narratives by providing an explanation that creates what I call FUD. And actually, I've taken this from the crypto world, where when prices go down very sharply, they talk about FUD, which stands for fear, uncertainty, doubt. And in today's world, it is in the financial media's interest to create FUD because fear gets us to read and click. And then, of course, it also serves Wall Street purpose, which is that it also gets you to act and trade. And so there's a double benefit because then Wall Street also is a big advertiser, if you will, in financial media. So they benefit from it. And the flip side is also there, which is that after a big move, which is upside volatility, which we like, financial media will also reinforce that narrative. And now you have the other side of FUD, and I created this myself. I call it GER, which is GER, greed, envy, and regret, that you are going to miss out because you've already missed out. You don't miss out. And this kind of cycle of financial media creating FUD and then GER, fudger, if you will, they have a fudger model in place, really can drive a lot of activity because ultimately for most people, it's our emotions that make us act. Fear on the selling side and greed, envy, regret, I should say FUD on the selling side and JER on the other, greed, envy, regret on the buying side. And so this is one more reason why we have a lot of volatility. Finally, I mentioned this, Wall Street, which is, the industry, which is brokerage firms and asset management companies, investment banks, they have an incentive for things to be volatile for you, so that you use them, so that you are buying and selling on a regular basis. When we had commissions, everyone sort of got that very, very intuitively, because obviously as you trade more and more, you generate commissions for them. But many people never think about, for example, bid and ask prices. These are the prices you see when you go to buy and sell. So when you go to buy, you pay the ask, and when you go to buy, you pay the bid. That spread is collected by any number of Wall Street players, and they benefit from that. So when you transact more and more, you're giving them your money, and always coming out on the short side of that. Another way that Wall Street benefits, for example, is that there are market makers, and they are nothing more than a middleman, and they have to accumulate at low prices to make a profit and sell at high prices, and others mark it up. And periods of FUD really help them accumulate inventory at low prices, which they can then mark up to you at higher prices. Money management firms, they benefit from volatility because, of course, during volatility, you might end up making a lot of bad decisions. Now you believe that you need them to guide you, and they, of course, charge you a fee. And I've done a video on how much these fees can really eliminate wealth that should be yours and end up going to money managers and financial advisors. So they benefit from that. And investment banks as well, they have a model where, for example, they are buying and selling companies. They also can benefit from this because, of course, at low stock prices, companies will need to do additional offerings. In other words, sell more stock to fund their business if they're a young company, or sell more debt. So it also feeds their interest. So bottom line is that the machinery of Wall Street also benefits from volatility. So those are 5 things that, based on my knowledge, understanding, experience, why stocks are so volatile. And you may be thinking, well, Paul, that's all great. And now you've told me stuff that, that makes me really think about all this next time I go to do something. But what's the answer? How can you avoid it? Well, personally for us, I would say we ask people to follow the rules of the game. And I've made a video on it, and you can check back in the YouTube archive and find this, that really tries to keep you out of doing some of these things that can hurt your long-term performance, which is ultimately where the big wealth is made. So that's my video for this week, which is that why are stocks so volatile? 5 different reasons why. Hopefully you found this interesting. If you did, like I mentioned, subscribe to the channel, give us a thumbs up, and comment below about what you thought about this video. And I'll have another video for you next week. Until then, this is Paul saying